Hi, everyone. This is Sharif Abdu. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Alan House and Charles Moran. We here at Value Line hope you and your family are staying safe and dealing with this difficult time as best as possible. So today, we're going to provide an update on the coronavirus and its ongoing impact on the economy and on the stock market. We will also discuss the actions Value Line is taking to help our subscribers navigate this difficult time. We will then recommend one stock to buy right now, and finally, we will answer any questions you may have. Please note, this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted there. So before I start the presentation, for those of you who are joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Now, one thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, and that includes the 1,700 stocks that are included in our service. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer, or our different tiers of subscriptions, that information can be found at valueline.com, or you can also call 1-800-VALUE-LINE. So, with the preamble out of the way, let's discuss the coronavirus, the economy, and the stock market. So the following content was prepared by Harvey Katz, Value Line's chief economist, and this is Harvey's latest economic view. Inflation is becoming a concern for Wall Street, with April data on producer, wholesale, and consumer prices proving unsettling. Specifically, the producer price index rose 0.6% last month, or twice the projected increase, and has increased 6.2% in the past year. Pressures also were building on the consumer side, as the consumer price index added 0.8% in April and 4.2% for the past 12 months. These troubling reports, along with climbing oil prices, supply bottlenecks, and selective shortages, gasoline for one example, has been rattling some heretofore complacent investors. So are such price concerns transitory, as the Federal Reserve maintains, or something more serious? It's too early to tell, to be sure. Upcoming PPI and CPI data will be critical, as will housing prices and cost trends in manufacturing activity and home building, with lumber especially important here. Meanwhile, the higher inflation already seen, the heavy sums allocated for stimulus and relief payments, and the possible future spending on infrastructure projects likely will contribute to at least a moderate sustained increase in prices.
Hey, Sharif, I just want to make sure, have you started sharing your screen? Because we're not able to see anything. Or are you still just...
I have not.
Okay.
I have not.
Just making sure. We have a lot of people who are worried about that.
Okay. And what can they see, Elliot?
Currently, just your name.
Okay. What I'll do at this stage is, can you see the Value Line homepage?
Nope, just currently your name at this point. If you click share at the top right-hand corner of the screen and then my screen, we'll be able to see whatever you have currently up.
Okay. How about that?
Perfect.
All right. Everybody's with me? We are on the Value Line homepage right now. And I'll return to my little dog and pony show. All right. So the next few weeks will be telling, both because of the release of new inflation figures, but also due to some key Federal Reserve issuances, such as the so-called Beige Book Economic Summation. A mid-June Federal Open Market Committee meeting, coupled with periodic commentary from Federal Reserve officials, also will be scrutinized for a sense of where the bank stands on inflation and interest rates. Meantime, the economy continues to ramble along, with most reports suggesting the business backdrop is neither too cold nor too hot. Highlights here include declines in jobless filings, stability in retail sales, and gains in industrial production. Investors often are on edge after months of unrelenting bullishness, with recent weeks seeing sharp sell-offs, but also dramatic recoveries. All the while, equity prices continue near all-time highs, especially on the Dow and the S&P 500 index. Conclusion. Stock prices remain high and uncertainties persist both domestically and globally. But with the economy still improving and first quarter earnings quite reassuring, the risk of being out of the market exceeds that of being in it. So that was the latest economic view written by our chief economist, Harvey Katz. And I want to focus on the conclusion to Harvey's write-up. And I quote, with the economy still improving and first quarter earnings quite reassuring, the risk of being out of the market exceeds that of being in it. And that really has been Value Line's long-term perspective, that equity should be a core component of a well-rounded, well-diversified portfolio, whether that's, in good economic times or less favorable times, in bull markets or bear markets, equities should be a core holding in investment portfolios of all stripes. So on that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, our time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy does cross our desk, we immediately publish a supplementary report that outlines the new information and, more importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. So at this stage, I am going to walk you through our website, which you can see right here. This is the Value Line dashboard. It's kind of like the homepage for Value Line. And as you can see here, we have stock market commentary, which is posted here on a daily basis. If you look at the right-hand bar here, the toolbar, you have all different categories. You have the analyzer, you have summary and index. And here I want to highlight supplementary reports. So as you can see here, Value Line's research department has been pretty busy, writing daily updates for companies, for their stocks, and basically information that might be noteworthy, both for the stock and for the company. So another thing that Value Line is doing is we are aggressively adjusting our financial strength grades. Although the economy is generally heading in the right direction, individual companies are still dealing with reduced demand for their offerings, supply chain problems, among many other issues. Consequently, we're seeing a trend of companies implementing cash-saving initiatives such as headcount cuts, slashing of advertising budgets, and adjusting their dividends. Another thing we're seeing, which is also both good and bad, we're seeing that companies are taking on additional debt as a means to build cash reserves. So we're taking all those factors into account. Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted on a regular basis in our selection and opinion newsletter. For those of you who don't know, financial strength, along with price stability, which is another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank, which is a very important measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website, and that would be right here, if you can see where I'm currently hovering my mouse. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Certainly, particular industries and sectors will recover more quickly than others during this period of time and after this pandemic runs its course. So typically, this is the portion of our presentation where we would walk you through the Value Line screener to select one stock to buy right now. This go around, we want to do things a little differently. We want to focus on one stock that we believe has aggressive growth potential in the near term. So on that note, we're going to take a look at a new model portfolio the Value Line has created, and that is the aggressive growth model portfolio. So to locate the aggressive growth model portfolio, you would start at the dashboard, which is where we are right now. And if you look at the right-hand side here, you look at this toolbar, you click on Investment Survey. And here you'll land on the page which shows you the latest issue of the Value Line Investment Survey. And you'll see different icons, and they're for different sections of the latest Value Line Investment Survey. What we're interested in right now is the standard R&R supplementary. That's the standard ratings and reports supplementary. So we're going to go ahead and click on that. And these are supplementary reports. So what we do every week in the Value Line Investment Survey, we basically encapsulate or summarize all the supplementary reports that we write for that week. And we put it in the back of the Value Line Investment Survey every week. So what's of interest to us today, we're going to scroll all the way down to the back page. So the second to last page of the R&R supplementary section. And this is the Value Line Aggressive Model Portfolio. We created this because we wanted to highlight stocks that have shown sort of above and beyond growth characteristics over the last 10 years. So the criteria to be included in this particular portfolio is when you average out a company's sales growth, cash flow growth, earnings per share growth, dividend growth, and book value growth over a 10-year period, the average has to be 9% or better. Okay, so it's consistent, steady, aggressive growth over a 10-year period. Not 1 year, not 2 years, 10 years. I'm going to go ahead and just make the page a little bigger so everybody can see. And there's a bunch of household names here. We have Alphabet, which is Google, Amazon, we have Anthem, which is healthcare services provider, Dollar General, Domino's Pizza. We have, a bunch of names that you would know: Microsoft, Netflix, Salesforce, United Health, et cetera, et cetera. But for this week and for this webinar about one stock to buy right now, the one stock that we really want to highlight is this company right here, Infosys Limited, ticker symbol INFY. So I'm going to go ahead and take you on the landing page. This would be sort of the home page for Infosys Limited. And if we take a look at the company's digital report, we see that the company is it's a global information technology services company, provides solutions for its clients through the entire software lifecycle. So that includes design and development, all the way through to maintenance and systems integration. A key client for this company is the banking industry, and Infosys Limited creates tailored software products for the banking industry. Now, if we take a look at the banner section of our digital report, we see that the stock is currently trading at about $19 a share, okay? $19 per share, that's what it's currently trading at. Now, if we look at the 18-month target price range, we see that we have a low of 17, a projected high of 49, and a midpoint of 33. So based on our projections for the next 18 months, we think that the stock has the potential to increase 75% over the next 18 months. So suffice it to say that the stock has room to run. So now let's take a look at the last full-page report for Infosys Limited. And I want to draw your attention right now. Let me make the page a little bit bigger so everybody can see. I want to draw your attention to the statistical array, which is this area here. We see all the numbers. And I want to look at revenues and share earnings for both 2021 and 2022. We're expecting solid earnings growth and revenue growth both this year and next. And that's thanks to the accelerated adoption of the company's digital product offerings. Of note, Infosys is collaborating with energy giant BP on an AI-based digital platform that addresses the use of low-carbon energy sources. Now, if we look at the stock again, this is sort of the icing on the cake. It has a timeliness rank of 2. So for anyone who's not familiar with timeliness, it's a very simple scale it's based on our forward-looking projections for price performance in the next 6 to 12 months. It's a very simple scale from 1 to 5. 1 meaning that's a stock that we expect to be the best performer in the next 6 to 12 months, and a 5 being a stock that we expect to probably trail the market in the next 6 to 12 months. So Infosys is ranked a 2, so we expect it to be a good performer in the year ahead. But we're not sacrificing quality in pursuit of growth. We see that Infosys Limited has a safety rank of 1, which is the very highest rank that we award any stock. And if we look down here at the bottom right corner of the page, we see that the company's financial strength rating is A++. Again, that's the highest rank that we award. So you're not giving up quality in order to get, the potential for growth. The stock also scores well on a number of other proprietary rankings. The price stability score of 80, earnings predictability score of 95, both very good. So the stock has strong near-term price appreciation potential with timeliness rank of 2, 18-month upside of 75% at the midpoint of our TPR. So all told, we think that Infosys Limited is in a strong position and can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. At this stage, we will tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, we recommend a review of our latest reports. The first few questions that were submitted prior to this presentation will be answered first. At this point, I will hand off to Charlie and to Alan. Guys?
Hi, this is Alan. I'll take the first question that came in. Somebody named Mike had a question regarding why do we use 10 years for the aggressive growth portfolio for the sales, the cash flow, and all the other metrics that Sharif pointed out. And the main reason we use 10 years is because generally over 10 years you'll have a couple different business cycles. I mean, we're currently been in an extended bull run right now, but generally over a 10-year period there will be some up market over that time and some down market over that time. So we feel it's a good indicator that a company can perform well in both up and down markets. So that's why we use that. And we also use all the metrics stated because we think it's important, obviously, for top line growth, the bottom line growth, book value growth. We want to make sure that it's growing very aggressively on all those metrics, because sometimes a company will grow sales aggressively, but the bottom line will grow aggressively. So we try to factor all that in, and as I said before, over what we consider an extended period of time of 10 years, if you could just give a little more indication of how a company will perform. So thank you. Okay, there's another question here about the timeliness rank, and as Sharif pointed out, the timeliness rank on Infosys is a 2. What that means is that our ranking system goes 1 highest to 5 lowest. So a 2 means that it is pegged to outperform the year ahead market averages. It's kind of like a bell curve as far as the timeliness ranks go. There's quite a few 3s, and then as you go up and down the scale, 1, 2, and then 4, 5, there's fewer of each one of those rungs, so to speak. But anyway, that's our proprietary ranking system. It has many factors in, some of which are price and earnings momentum based, but there are some other factors that we add into that as well. But as Sharif said, Infosys is ranked 2, meaning that we do deem it to be a market outperformer in the year ahead.
Hello, this is Charlie Moran, and we had another question from Elise, who asked about the aggressive growth model portfolio and wondered if the current market conditions that are prevailing right now, does that make the timeliness rankings less reliable? And to that, I would say that these rankings are calculated consistently almost every week, and they are not dependent on the variability or the volatility in the capital markets. Again, as Alan alluded to, the 1,700 stocks, it's much like a bell curve, and so that they are going to be ranked on a relative basis. What else? Alan, do you see any other questions?
Someone actually had an interesting question about the 18-month target price range. Value Line has historically had the timeliness rank, which is basically for the year ahead. I think measures a 6 to 12-month investment horizon, and we also had the 3 to 5 year, target price range, which is a little more on the longer term. And then we realized that there are people that are looking at intermediate range. They want something right around a year and a half, 2 years, that kind of price range. So we introduced the 18-month target price range. I believe it was about 2 years ago, give or take. And so that's a good measure of kind of like the intermediate gains potential for the equity. So as you see, as Sharif alluded to, the midpoint of Infosys target price range, I think, is 75%. So it's obviously it's very strong on intermediate term basis as well as a short term basis.
Finally, I'm seeing a lot of questions regarding Infosys and their exposure to India and how that would affect the ranking for Infosys, given the problems that have emerged and the reoccurrence of the relapse of COVID. Again, the ranking system is going to be, at that point in time, based on price momentum and valuation, and there is also a component of estimates factored in to the timeliness rank. So to the extent that there are estimates on the page at that point in time, those are waiting in the time-minus ranking system. However, the impact of COVID, isn't known on Infosys at this time. So, again, that's a fundamental factor to consider, and that would theoretically show up in the future earnings estimates of Infosys. Alan, anything else?
Yeah, I just want to also allude to that. Now you brought up like like the India situation and things like that. If something did happen, either good, bad, or somewhere in between Infosys, that's newsworthy, we would publish a supplementary report. That day immediately after the news is made available. So if just keep an eye on the supplementary reports because if there's anything noteworthy, we will certainly publish an update as far as what's going on with Infosys.
Okay. I think that's it, Alan. Nothing more on my end.
Yeah, I just wanted to remind our listeners that if you would like to subscribe to Value Line, you could call 1-800-VALUE-LINE or go to www.valueline.com. Thank you. I think that's, thank you all for joining us. Elliot?